In this chapter, we study adjustable rate mortgage. Adjustable rate mortgage is different from fixed rate mortgage or gradual payment mortgage. For fixed rate mortgage and gradual payment mortgage, the interest rate is fixed, and fixed rate mortgage have a fixed interest rate and fixed mortgage payment. Gradual payment mortgage has a fixed interest rate but predetermined payment patterns, so the mortgage payment for gradual payment mortgage may be different over time. Adjustable rate mortgage do not have a fixed rate interest rate or do not have a predetermined payment pattern. It helps to do the risk sharing between borrowers and lenders, because for fixed rate mortgage or gradual payment mortgage, lender cannot charge a higher interest rate when market interest rate goes up. But for adjustable rate mortgage, the borrower are paying a lower interest rate when market rate goes down, and they are paying a higher interest rate when market rate goes up. Adjustable rate mortgage became popular in 1980s. If you look at the following information from the Board of Governors of the Federal Reserve System, the x-axis is the timeline and the y-axis is the interest rate pattern. So in this graph, it shows the car loans, which is the black line, and the personal loans, which is the green line, and the gray line, which is for the mortgage interest rate. So what we can see is the nominal interest rate on the mortgage is 24 months bank personal loans and 48 months bank car loans. They all increase at the 1980s. So adjustable rate mortgage became popular at that time because if you are borrowing at a historical high interest rate, the expectation that in the future mortgage interest rate goes down is very reasonable. By borrow through adjustable rate mortgage, your interest rate will automatically be adjusted downward if the market interest rate goes down in the future. That's why adjustable rate mortgage became popular in the 80s. Now let's look at what is interest rate risk. Interest rate risk means the lender signs a contract with a lower interest rate, and when market interest rate goes up, they were not able to charge a borrower a higher interest rate. For example, the inflation is higher than expected, which will result loss to the lender due to the inaccurate prediction of interest rate. Let's look at this example. Suppose the lender signs a contract with the borrower at an interest rate of 10% for a loan of $600,000 for 30 years. The loan is repaid after 10 years. As soon as the contract is signed, the market interest rate increases to 12%. So what is the loss to the lender? The lender have to make commitment to this 10% interest income, while the market interest rate is 12%. First, let's calculate what is the monthly payment for this loan. So the loan amount is $600,000. The number period is 360. Monthly interest rate equals to 10% divided by 12. The future value is 0. We can calculate the monthly payment for this loan is $5,265. If the loan is repaid after 10 years, we need to calculate what is the outstanding balance at the end of year 10, which is the future value. The present value is $600,000. The number period is 10 years, 120 months. Monthly interest rate equal to 10% divided by 12. Monthly payment is calculated from the first step, $5,265. Note that present value is a cash inflow. We denote it as a positive number, so the monthly payment is a negative number as a cash outflow. We can calculate the outstanding balance future value at the end of year 10 is $545,628. It is a negative number because it's a cash outflow you have to pay to the bank. Now we know the monthly payment for this loan is $5,265, and the balance is $545,628. That is the cash flow the lender is going to receive. How much does this cash flow worth for the lender at today's value? we need to find the present value of this cash flow discounted at the current market interest rate, 12%. Now we need to find the present value for the future cash flow of this mortgage to the lender. So the future value is $545,628. The number period equals to 10 years, 120 months. Annual interest rate is market interest rate 12% divided by 12. The monthly payment is $5,265. Please note here, both future value and monthly payment are positive number because we are calculating the present value of this future cash flow to the lenders. So the monthly payment and outstanding balance are the money the lender receives. So we can compute this future cash flow at a current market interest rate of 12%. So this future cash flow is worth $532,328 to the lender. So the lender gave the borrower $600,000 today, but the future value received from the borrower is only worth $532,328. The difference between these two will be the loss to the lender, because the lender signed a contract at 10%, but market interest rate jumped immediately at 12% after origination of this loan. So what is the impact of the interest rate change on the loan value? That is called interest rate risk. Let's assume a $100,000 value loan for 30 years, 8% mortgage. What is the impact on the loan value if interest rate changes right after origination? Let's see the graph on the following slide. This graph shows the representation of interest rate risk. What we can see, if the market interest rate is 8%, the same as the contract rate, the present value for all the future cash flow to the lender of this loan will be the same as the loan amount, $100,000. If the market interest rate increases to 12%, then the future value of the cash flow will be discounted at 12%, which is only worth $71,335.37. It is lower than $100,000, the loan amount the lender gave to the borrower. So the lender suffers a loss here. Alternatively, if the market interest rate declines, if market interest rate is currently 4%, then the future cash flow of this loan is worth $153,695.24 to the lender. It is worth more to the lender than the loan amount they gave outside to the borrower at $100,000. But please keep in mind, if the market interest rate drops from 8% to 4%, the borrower always has the option to refinance the loan and enjoy a lower market interest rate. So this change is not symmetric to the lender. Lenders suffer a loss if the market interest rate increase is higher than the contract rate, but they do not enjoy benefit if market interest rate declines become lower than the contract rate. That is interest rate risk to the lender. Adjustable rate mortgage, the rate is adjusted, is linked to the commonly used market indices. So the interest rate we use to adjust the adjustable rate mortgage, the indices usually include the 6-month Treasury bills, or the 1-year, 3-year, or the 5-year Treasury securities, or the weighted average of the National Cost of Fund, compiled by the Federal Home Loan Bank Board, or the national average of fixed-rate mortgage on the mortgage loans, compiled by the Federal Home Loan Bank Board as well. So the key idea for the index for the adjustable rate mortgage is it should be easily observable and verifiable number. As a borrower, at a date for the rate adjustment, you could wake up and check those rates online to say what is the interest rate you will be paying for the incoming period. The component for the adjustable rate mortgage. Adjustable rate mortgage usually start at very low interest rate. Lower than the market rate, we call it a teaser rate. This teaser rate will last for a few years. After that, the rate will start to fluctuate. It will be linked to the market interest rate. So when market interest rate goes up, the adjustable rate mortgage will have a higher interest rate. If market interest rate goes down, adjustable rate mortgage will have a lower interest rate. However, there is limit on the interest rate adjustment. Caps specifies the maximum increase allowed in the payment, interest, maturity extensions of the loan balances if there is negative amortization. So there is caps on the interest rate change between every period or over the life of this loan, which means if adjustable rate mortgage equals to a premium plus the market interest rate every period, when this sum exceeds the cap for this loan, the interest rate the borrower will be paying will be the cap rather than the sum of premium and market interest rate. So the adjustable rate mortgage, the composite rate equals to the index plus margin. The index is some indices which is easily verifiable and accessible by the borrowers. We have some examples in the previous slide. The margin is a premium in addition to the indices chosen by the lender. So the margin you paid depends on the risk of the borrower. If the lender decides the borrower have a high risk, they need to pay a higher value of margin. The adjustment interval to reevaluate, redecide the rate you are paying for adjustable rate mortgage is usually 6 months or 1 year. For adjustable rate mortgage, there are the similar clauses related to the fixed rate mortgage. It has discount points, prepayment clause, which is usually no penalty with adjustable rate mortgage because it will automatically adjust to the market interest rate. If you prepay, the lender can just take the money and lend it out at the similar market interest rate. So there are no loss for the lender. That's why there are usually no prepayment penalty with adjustable rate mortgage. And assumability as well. You could transfer your current interest rate to the new buyer of this property because lender just enjoy a rate linked to the market interest rate. So it doesn't make much difference for the lender. Similar to the caps, adjustable rate mortgage also have floors, which is when the market interest rate goes down, you are going to pay a lower interest rate. But floors specify what is the maximum reductions on interest rate between the period or over the life of this loan. So if the market interest rate is really low and the margins plus the market index value is below the floors, you have to pay the floors on interest rate. Negative amortization will happen when the required payment is higher than the payment cap, which means the monthly payment you should pay is higher than the payment cap restricted by adjustable rate mortgage. So you end up paying the amount specified by the payment cap. The payment cap is not enough to cover your amortization and interest payment. The difference will be compounded and added to the balance. So the balance is growing over time, which we call negative amortization. For adjustable rate mortgage, the interest rate risk is not completely eliminated. What if the market interest rate to move to 12% on the day after origination? We could not change the rate on the adjustable rate mortgage immediately to 12% because there are monthly adjustments happens, and we also have cap, which restricts the interest rate we can change. A typical adjustable rate mortgage is indexed to T-bills, which is the bill issued by the US government. We usually take it as risk-free indexes. And the rate and the payment usually adjusted at annual term, which is less costly. and the rate and payment adjustment is limited by the annual caps of 2% over every year or 6% over the life of the loan, which means the increase in the interest rate cannot be higher than 6% from the beginning interest rate over the entire life of this loan. And negative amortization is not permitted. It's really fully amortize the loan. And the maximum loan-to-value ratio could be 95%. But primary mortgage insurance is required if the loan-to-value ratio is between 80% to 95%. It is usually a 30-year loan term. There are some considerations on adjustable rate mortgage. Both lenders and borrowers, they face uncertainty when they choose adjustable rate mortgage because the interest rate for this loan will change with the market interest rate. There is uncertainty in the market interest rate, so there is uncertainty on the rate for adjustable rate mortgage. There is risk premium. Adjustable rate mortgage typically have a higher default rate than fixed rate mortgage. Because adjustable rate mortgage start with a really low interest rate, fixed for a period of time, we call it teaser rate, which means the income you need to qualify for adjustable rate mortgage at origination does not need to be really high. But in the future, when market interest rate increase, you have to pay a higher mortgage payment every month. Your income increase will not be enough to cover the mortgage payment every month. You may have difficulty to pay the monthly mortgage payment, which will lead to a higher default rate. The interest rate risk is now shared by the borrower and the lender. How much is shared by each party really depends on adjustable rate terms, the frequency for adjustment, and the premium on the rate. Ceteris paribus, at the time of origination, the expected yield on an adjustable rate mortgage should be less than the expected yield on fixed rate mortgage. Expected yield means the expected return lender calculated, because for adjustable rate mortgage, the borrower is accepting some or all of the interest rate risk. So the lender share a smaller proportion of interest rate risk for adjustable rate mortgage. That's why a lower risk, a lower return. Now let's look at expected yield and adjustable rate mortgage properties. The expected yield on adjustable rate mortgage is smaller than the expected yield on fixed rate mortgage because the lender share a lower amount of interest rate risk. The lower risk, the lower return. But keep in mind the actual exposed yield on adjustable rate mortgage could be higher than the fixed rate mortgage because there is uncertainty in the future rate change. And if a short-term index as opposed to long-term indexes is used with adjustable rate mortgage, it is riskier for the borrowers because they're facing a higher interest rate risk. So it's less risky for the lender. The lender will ask for lower expected yield. If there are bigger caps on the adjustable rate mortgage, which means the lender can increase the interest rate with more flexibility. It's riskier for the borrower and less risky for the lender. The lender will ask for lower expected yield. If there are shorter time intervals between the adjustment, it is more risky for the borrower because they are going to share a larger percentage of interest rate risk. So it's less risky for the lender. Lender asks for lower expected yield. If there is negative amortization, it is risky for the borrower, and the lender will ask for a lower expected yield.